Okay, so hi, good afternoon. Last time we discussed the derivatives and risk management. So we were able to discuss some of the um, instruments such as the options, the swaps, the futures and forwards. And then we also discussed the risk management. Okay, so particularly those risks that are associated with financial transactions. Now, we are going to discuss the multinational financial management. So, we are going to discuss the difference between the multinational versus the domestic financial management. And another is we will discuss the exchange rates and the trading in the foreign exchange. We have the international monetary system. We have the concept of the interest rate parity. We have purchasing power parity, and we have the role of the inflation, the international credit markets in the international financial management, and lastly, um, the international capital budgeting. So we will also tackle what is the difference between capital budgeting, um, using capital budgeting in the domestic operations and capital budgeting in the international operations. So first, let us define the multinational corporation. So a multinational corporation is a corporation that operates in two or more countries. So the operation is not only limited to its home country or to the domestic country, but it operates in other countries. The decision making within the corporation may be centralized. So the decision making can be centralized, meaning all the decisions come from the home country or the headquarter, or it can be a decentralized, so across the countries in which the corporation does business. So take for example the Sun Life of Canada nga company. So before, all the decisions will come from the international headquarter. So all decisions come from the Sun Life of Canada. Okay, but in the later years, so the Sun Life of Canada decided to give this decision making to to those countries that they have a branch with. Okay, so for example, so in the Philippines, so it is now called the Sun Life of Canada Philippines. So all the decision making is not uh, is not anymore dependent on the Canada branch, but the Philippines, the Philippine branch can make its own decisions, make its financial decisions, and uh, all decisions regarding how to grow the company. However, their limitation is that they can only operate or they can only sell their products, insurance or mutual funds inside the country of operation. So, what are the reasons why the firms expand in other countries? So, first reason is to seek production efficiency. So, there are countries that have a cheaper cost of labor, or the cost of materials probably is cheaper compared to their home country. So that is why to seek efficiency, so they expand into other countries. So for example, so many companies or firms put up their manufacturing in the China because they believe that uh, China have a cheaper cost of labor. So and they are also efficient in producing their goods. So that's also the advantage that they are seeking to have over their competitors. Second is to avoid the political and regulatory hurdles. So there are some countries don't have the equal um, way of doing things. Okay, so for example, some countries have a different way of taxing their citizens and their businesses, and they have a different tax rates. Some are higher, some are tax exempt, or some they have a less tax rates. So in terms of regulatory, so other countries are very strict in regulating these types of industries. Other countries are more open and have an easier way of doing business there. So firms expand into other countries to avoid those hurdles. So perhaps they view their country as a very high political risk. So they look for countries nga low ang political risk, or perhaps the taxation in their country is very high. So they will go to countries nga they will have a less tax, or perhaps they will be exempted from paying tax. Another reason is perhaps they want to seek new markets. So for example, for Jollibee Foods, okay, so Jollibee is now expanding into the US. So simply because they want to seek new markets. Okay, so of course, it is also to avoid the maturity, or to to be in a situation where the profits are already declining. So they want to seek new markets to increase their sales and thereby increase their profits. Fourth reason is they want to seek raw materials and new technology. So, so for example, if you are into a business of making chocolates, so there are countries that have, and of course, the main ingredient or the raw material in making chocolates are the cacao beans, okay, or the cocoa beans. So, for them to have a cheaper cost of raw materials, so they would probably go to those countries that have abundance of their, or very abundant of their raw materials. So perhaps they can go to Brazil or to South America, or perhaps to some Southeast Asian countries. So they also want to seek the new technology. So perhaps there are countries that are more advanced, or more have the new technology on producing things. Okay, so they will go there so that they can uh, implement or make use of the new technology. The fifth reason is why do firms expand into other countries is perhaps to protect their processes and products. So, of course, they want to be located far from their competitors, so they can better protect their processes and products. Another reason is to diversify. Okay, so each country have their own risk. Okay, so we have the political risk and other risks. So if they want to diversify their operations and not be affected by the risk of that country, so it's better to diversify their business outside. So for example, if they want to not to be affected with the bad economy inside their home country, let's say Philippines. Okay, so right now, Philippines is experiencing badly. Okay, so in terms of economy. So, however, there are countries that are already recovering from the COVID-19, and thereby will have a faster economic recovery. So even though in the Philippines, their operations are having negative profits, okay, or suffering economically or financially, their operations outside is probably gaining or profiting. Okay, Number seven is to retain the customers. So perhaps their largest customers is located in that country. So because their largest customers are there, so they want to be near to their biggest customer. So now let's talk about the difference between the multinational financial management and domestic financial management. So first issue that we will encounter when we manage our finances outside of the home country is the we have to be you have to be aware of the different currency denominations. Okay, so this will affect our financial reporting because we are going to report or we are going to translate our, let's say, outside operations to the country in which we are submitting our financial reports. So, for example, if you are your headquarters is in the U.S. and then you are operating in Europe or Asia, you have to translate the currencies in the Asia and Europe first to dollar. Okay, so the currency, the translation of the currency will have an impact to the financial reporting. Second is the political risk. So in managing the domestic financial management, you are only observing the political risk, or you're only managing the political risk inside the country or the domestic country. But now, since you're operating in several countries, so you have to understand the different political risk in each of these countries that uh, we have operations. The third difference is that the economic and legal ramifications. So each country have different economic provisions, economic laws, and legal system. So we have to be aware of the economic system and the legal ramifications in each country that we have an operation. The role of governments. So some countries are heavily intervened by the government. Some countries are very free and the private entities can make decisions with less intervention from the government. So let's say in some communist countries, so the government has a major role or can really have a major intervention in the business operations of their country. Okay? While in the democratic countries, okay, so there are less intervention coming from the government. So we have the language and cultural differences. So operating outside, of course, you have to hurdle this uh, issue, okay, the language barrier and the difference in the culture of each country. So since we are the ones um, operating outside the country, so we intend to have a good business in that country. So we have to be aware of their language and the culture, the difference in the culture. So this is to avoid the disappointment from our customers as well as the employees in that particular countries. So for example, in the Spain, so they have a culture that every afternoon they have to sleep for at least an hour. So in the Philippines, we call that the mañanita. We call that the mañana habit, okay, or the siesta habit. So since it is already part of the Spanish culture, then we have to respect that culture, and our business operation should allocate for that hour or two for sleeping in the afternoon, okay? Because that's already part of their culture. And perhaps the management there should at least try to understand the Spanish language so that they can have a better business with the suppliers or customers and employees there. So now let's have the foreign exchange rates. So I know that we are already familiar with this. Okay, so we have already we can see this in the news, in the newspaper, even in the websites. So especially if you have families with working overseas. So of course the money that they are sending here is converted. So let's say in the Philippines. So if they are working in Japan, so the yen must be converted into Philippine peso. Or if one of your relatives are working or your parents are working in the United States, so the money that they are sending here convert can be converted should be converted in the Philippine peso. Okay. So of course, the exchange rate will depend on the demand and supply uh, for that currency. So let's have an example of the Japanese yen and the Australian dollar. So the Japanese yen, so for $1 to buy a Japanese yen, so so we need to have a point 0.009. So the equivalent of $1 to Japanese yen is point 0.009. And then for Australian dollar, $1, no, the equivalent of the one Japanese yen, sorry, the equivalent of the one Japanese yen is point $0.009, and for Australian dollar is um, point 650 US dollar to buy one Australian dollar. So are these currency prices direct or indirect quotations? So since they are prices of foreign currencies expressed in dollars, so these are uh, foreign currencies exchanged to dollar. So these are called direct quotations. Okay, so direct quotations. So now you may be wondering why we are converting these currencies to dollars. Now, if English is the medium, um, the international medium of communication, the dollar is also the international currency. So that's why um, in most of these discussions, all these currencies are we try to convert them into dollar or US dollar to be specific. Indirect quotation is simply the reciprocal of the direct quotations. So, or in other terms, it is the number of units of foreign currency per US dollar. So, the equivalent of $1 is equivalent to 111.11 Japanese yen. Okay, so again, $1 is equivalent to 111.11 Japanese yen. So, how to get this amount? So, you simply divide the 1 over the direct quotation, which is 0.009. So again, 1 divided by 0.009. So you will get 111.11. For Australian dollar, or the number of the Australian dollar, which is equivalent to $1, so that's 1.5385 Australian dollar. So the $1 is equivalent to 1.5385. So again, to get this, simply divide $1, 1 divided by the direct quotation for the Australian dollar, which is 0.65. So this is indirect quotation. So it represents the number of units of a foreign currency needed to purchase one US dollar. So again, we are converting this foreign currency, or what is the equivalent of $1 to foreign currencies such as the Japanese yen and Australian dollar. So we call that indirect quotation. While the direct quotation is the equivalent of $1 to the foreign currency, or one foreign currency. Let's say the one Japanese yen is equivalent to uh, how many dollars, or the one Australian dollar is equivalent to how many US dollar. The indirect quotation is also known as the reciprocal of the direct quotation. So next, what is a cross rate? Okay, so the cross rate is the exchange between any two currencies. So cross rates are actually calculated on the basis of various currencies relative to the US dollar. So, so for example, so we have the yen versus the US dollar. So per US dollar, we have 111.11. So we have to multiply this with the exchange rate between the US dollar and the Australian dollar. So they so we have point 650. At least we can actually eliminate the US dollar, and we have yen over um, Australian dollar. Okay, so you can simply get the equivalent of the yen per US dollar, or simply 111.11, and then, or perhaps 11.11 times the equivalent uh, of the Australian dollar to US. So which is 0.650. So we can say that it's actually the indirect quotation of the Japanese yen divided by the direct quotation of the Australian dollar. Okay? So to get the cross rate of um, of both currencies. So the answer is, so the yen and Australian dollar 72.22, which means that for every Australian dollar, the equivalent is 72.22 yen. To get the inverse of the cross rate yield, so uh, simply get the indirect the reciprocal of this. So you have 0.0138 Australian dollar per yen, or the equivalent of 1 yen to Australian dollar is 0.0138. So let's have examples. So we have the orange juice. So we use the cross rate to determine the price that will be set in that particular country. So a firm can produce a liter of orange juice and ship it to Japan for $1.75 per unit. Okay. So we can produce. So the cost of that juice is $1.75 per unit. So the firm wants to have a 50% markup, okay, of the on the project. So what should the juice sell for Japan? So $1.75, the cost times the 1.50. So we are actually converting this first to the sales price in dollar. Okay. So that's the sales price. Now we have to translate or convert it into yen. So the equivalent of 1 yen is 111.11. So the result of this times the uh, yen per dollar. So the price that will be set in Japan is 291.66 yen. 291.66 yen. Okay, so how to determine the profit? So the product will cost 250 yen to produce, so we are producing the product, the orange juice in Japan, and then we will ship it to Australia to sell the orange juice. So in Australia, it can be sold for $6 Australian. Okay, so take note Australian dollars. But in the financial reports, we have to convert these sales or the profits to the US dollar. Okay, so what is the net income in terms of US dollar? So first, let's determine the cost in Australian dollar. So we have determined the cross rate. Okay, so per 1 yen, the equivalent of the Australian dollar is 0.0138. So we have already computed this using the inverse cross rate or the A dollar to yen or 1 yen per or the equivalent of 1 yen to Australian dollar. So since we already have the yen, so multiply it by the its inverse cross rate 0.0138. So you have a cost of 3.45 Australian dollar. Okay, so Australian dollar. Now the question is the dollar profit. But we have to get first the profit by deducting the cost from the sales. So so 6 minus 3.45. So the total Australian dollar profit is 2.55. So the last step would be to convert this Australian dollar to US dollar. So we know that the Australian dollar is equivalent to um, 1.5385. Okay, so 1.5385 US dollar. So the final amount or the profit in the US dollar is 1.66. Okay, 1.66. So okay, so now we understand the that translation or converting the foreign currency to dollar or to the home country, okay, has an exchange rate risk. So when we say exchange rate risk, it is the risk that the value of the cash flow in one currency translated to another currency will decline due to the change in exchange rates. So we can actually feel this, diba? Since in the Philippines we have relatives that are working outside. So for example, if they are working in the US, okay, so they are if the Philippine peso is stronger than the US dollar. So we say the Philippine peso is stronger than US dollar, the value of $1 becomes lesser uh, compared yesterday. Let's say yesterday we have $45, 45 peso per $1. So today we have 44. So the Philippine currency is now stronger than the US. So it is good news for our country because of course the imports will now have a fewer cost. However, for those who are sending their money in the country, so let's say they are remitting in US dollars. So this is bad news because the $1 is now lesser. Okay? So kung sa una 45 per $1, karon 44 na, which means that their remittances to their families is now lower compared before. However, if the exchange rate, let's say the US dollar is now stronger in relation to the Philippine peso, let's say it becomes 50 per US per 50 pesos per $1, then it is a good news to the families of course, both OFW and the family of the OFW because they now have a higher amount. Okay, so this exchange rate risk depends on the role, kung if you are the importer or the exporter, or if you are operating inside the country and then you're selling, or perhaps you are buying things outside. So if you are buying things, so you want a stronger currency in the home country compared to the outside. But if you are selling your products there, so um you want the current your home currency to be weaker compared to the currency outside. So for example, in the last slide, a weakening Australian dollar. So if some currency is weakening, then the other must be strengthening. Okay, so if the Australian dollar will be weakened, so it would lower the US dollar profit. So we have the International Monetary System. So it is the framework within which exchange rates are determined. So the International Monetary System is also known as the blueprint for the international trade and capital flows. So we have to be familiar with this exchange rate terminology. So we have the difference between the spot rate and the forward exchange rate, the difference between the fixed and the floating exchange rate, the devaluation and revaluation, and lastly is the depreciation and appreciation. So when say freely floating, so the exchange rate is determined by the market supply and demand for the currency. So the supply and demand for that particular currency determines the exchange rate. So if there's a high demand currency, so the currency will tend to be stronger. Okay, or if the supply is high compared to the demand, so the exchange rate will for that currency will be lower. So governments may occasionally intervene. So they can occasionally intervene by buying and selling their currency to stabilize fluctuations. But most of the time, they just let the supply and demand determine the exchange rate. So in the case of the Philippines, we're actually using the freely floating monetary arrange agreements. Managed floating. So there's a significant government intervention. So the government manages the exchange rate by manipulating the currency supply and demand. Okay, so the target exchange rate, of course, is being kept. Okay, so because if the speculators or those who are engaging in the forex trading or the foreign exchange trading, so they already know what is the the target exchange rate, so they can automatically sell their currency if the target has already attained. So so to prevent that from happening, so the government in the managed floating system should keep the target exchange rate or keep it a secret. Fixed monetary agreements. So in the fixed monetary agreement, so it can be no local currency. So this country uses either another country's currency as its legal tender. So like the US dollar in Ecuador or perhaps in Zimbabwe. So especially those countries that are experiencing mga hyperinflationary situation or hyperinflationary economy. So um, they will like the US dollar is more valuable compared to their own currency. Or perhaps they belong to a group of countries such as in the Europe, so they have a single currency called euro. We have the currency board arrangement. So in this type of monetary agreement, so the country has its own currency, but it commits to exchange it for a specified foreign currency at a fixed exchange rate. Okay, so example, Argentina before the January 2002 crisis. So they have a target fixed exchange rate. So they have their own currency, but uh, they will exchange it for a for a specified foreign currency. But of course, there is a fixed equivalent for that foreign currency. So let's say $1 is equivalent to let's say 50 Argentinian peso. So the last fixed monetary agreement is called the fixed peg arrangement. So this country pegs its currency to another or a basket of currencies at a fixed rate. So slight fluctuations are okay, but the rate must stay within a desired range. So for example, is the Chinese yuan. So it is pegged to a basket of currency. So the equivalent of the Chinese yuan is dependent on the different basket of currencies. But of course, it has a fixed rate. Okay, so it does the exchange rate does not fluctuate spontaneously, or it does not fluctuate most of the time. So what is the difference between the spot rates and forward rates? So the spot rates are the rates to buy currency for immediate delivery. So today, okay, so what is now the exchange rate between the US and Philippine peso? So if you exchange your $1 to Philippine peso today, so that is the exchange rate that it will be converted. So let's say it's 45. So $1 is equivalent to 45. And that is the spot rate. But if the rate is in the future, okay, so the rates to buy the currency at some agreed upon date in the future, so it's called the forward rate. Okay, so this is particularly true if your raw materials are purchased outside. So to avoid the fluctuations of the exchange rates, so some companies are already entering into forward exchange rates contracts. So they will buy currency at the future. Okay, so the rates may probably uh, different than the spot rate or the same. So when is the forward rate at a premium to the spot rate? So if the US dollar buys fewer units of a foreign currency in the forward than the spot market, the foreign currency is said to be selling at a premium. Okay, so which means nga mas mahal ang um, mas barato ang spot rate, or the currency in the spot market is cheaper compared to the forward rate. So it's called premium selling. The foreign currency is selling at a premium. Otherwise, it is selling at a discount, which means that in the forward exchange rate contract, so you can buy uh, more units of the foreign currency than in the spot market. So the rates in the forward is cheaper relative to the spot market rate. So the primary determinant of the spot or forward rate relationship is the relative interest rates. Okay, so the reason why there's a difference between the spot and the forward rate is due to the interest rates. So which brings us to the interest rate parity. So according to the interest rate parity, so um, the amount or the value in the spot and the forward rate is the same if the interest rate is absent. So interest rate parity holds that investors should expect the same return in all countries after adjusting for this interest rate risk. So we have this formula. So FT stands for the forward exchange rate uh, in the future. So T, it can be 30 days, 60 or 90 days. And the EO, or it is the today's spot exchange rate. So we have one plus the risk in the home country over one plus the risk in the foreign country. So all the money is equivalent regardless on which country as long as the interest rate is uh, the same. So evaluating the interest rate parity, suppose 1 yen buys 0.0095 US dollars in the 30-day forward exchange market, and the periodic nominal rate for a 30-day risk-free in Japan is 4%. Okay, so take note this 4%. So every time we encounter the interest rate, it is always expressed in annual terms. So we have to convert this first to its let's say this is 30 days, so it is a monthly. We have to get first the monthly periodic rate. So both 4%, so divided by 12, so you have 0.333, and the forward rate is 0.0095. So if each country has the same risk, so the spot rate is the same. Okay, the forward rate and the spot rate is the same. So if the forward exchange rate is 0.0095, then the spot rate, if they have the same interest rate or same risk, it will have an equivalent 0.0095. So for the interest rate parity to hold, so the spot rate should be equal to the forward exchange rate. However, if the spot rate is equivalent to 0.0090, then the interest rate parity does not hold. So let's talk another parity. No, this is still continuation of the interest rate parity. Which security offers the highest return? Okay, so actually it's the Japanese yen that offers the highest return. So let's say we will convert the 1,000 US dollar to yen in the spot market. So by the way, this is actually in comparison with the Japanese and the Australian dollar. So the spot market for yen, okay, is 111.11. So 1,000 is equivalent to 111,111 yen. Now we will put this yen to the forward exchange rate. So in a 30-day Japanese security. So now the spot rate on so the return after 30 days is the 3.33 or 0.00333. So we already have the already calculated this. So this is the periodic nominal rate for 30 days. So the 111,111 yen is now equivalent to 111,481 yen after 30 days. So the forward exchange rate, so if we agree today to exchange the 111,481 yen, uh, 30 days from now at a forward rate, so the equivalent of this amount to dollar is at 1059.07. So we have a gain of $59. So that is equivalent to 5.907%. So 30 days lang ni siya nga rate. So to get the nominal annual return, so since 5.907 is for 1 month, so multiplied it by 12 months, so the total nominal annual return is 70.88%. So the another parity is called the purchasing power parity. So purchasing power parity implies that the level of exchange rates adjusts so that the identical goods cost the same amount in different countries. So according to the purchasing power parity, the value of the goods is the same in each country. Okay. So although we are experiencing mga difference in the exchange rates, but according to the purchasing power parity, they have the same value. So we have this formula. So the price in the home country is equivalent to the price in the foreign country multiplied rate or the EO. To get the spot rate, so the price of the home country divided by the price in the foreign country. So for example, so the grapefruit juice costs 2 pesos, $2 per liter in the US, and the uh, purchasing power parity, if the purchasing power parity holds, what is the price of the grapefruit juice in Australia? So um, we know the spot rate for the equivalent of one Australian dollar to dollar. So one Australian dollar is equivalent to 0.65 US dollar. So to get the price in that country in Australia, so we will divide 2 pesos, $2 rather, by its spot rate, which is 0.65. So therefore, the cost of that grapefruit juice in Australia is 3.0769 Australian dollars. Now, what impact does relative inflation have on interest rates and exchange rates? So if there's a lower inflation, it leads to lower interest rates. So borrowing in low interest countries may appear attractive to multinational firms. However, currencies in those low inflation countries tend to appreciate against those in high inflation countries. So the effective interest cost increases over the life of the loan. So in other words, even though you are borrowing money from those countries with a low inflation, okay, however, to convert those money from foreign country to your home currency, it will still be the amount still be higher, especially in the over the life of the loan, because you will be paying in that currency, and the equivalent of that currency to the foreign country is high, which means that in those countries with low inflation, they have a stronger currency. Then let's talk about the international credit markets. So we have the euro credits. So the euro credits have a fixed term. So it has a floating rate bank loans with no early repayment. So an example would be the euro dollar deposits, which are US dollars deposited in banks outside the United States. The euro bonds, so it's a medium to long term international market for the fixed and the floating rate debt arrangement or debt. So it is also underwritten by an international bank syndicate and sold to investors in countries other than the one in whose currency the bond is denominated. Foreign bonds, so it is issued in a capital market other than the issuers. So the only thing foreign about it is the borrower's nationality. So most of the investor or bondholders of these bonds are not from that country. So let's say the US will issue foreign bonds. So its own US citizens cannot purchase these bonds, but it will be purchased by other nationalities. So we have American Depository Receipts or the ADRs. So ADRs are certificates representing ownership of foreign stock held in trust. So about 1,700 ADRs are now available in the United States, with most of them traded on the over-the-counter market. However, more and more ADRs are being listed on the New York Stock Exchange. So in the Philippines, we also have Philippine depository receipts. So these depository receipts are bought by the foreigners. Okay, so since in our country um, they cannot own more than 40% of shares, so they usually buys these depository receipts to be able to invest in that business. So if you can recall, so this has also been the issue in the Rappler, because in the Philippines, the media cannot be owned by foreigners. So it should only be owned 100% by Filipinos. But a lot of media companies in the Philippines, GMA, ABS-CBN, so some of them, foreigners are investing in the depository receipts. Okay, so the depository receipts does not really have um, or does not give the right to the shareholder or the owner the right to control or manage the business. So they are investing or they are buying those depository receipts simply because they want to have a share in the dividends. However, the control and management is not only evidenced by these depository receipts, because some depository receipts have an agreement. Okay, so for example, in the case of the Rappler, so based on the Supreme Court decision, so it cannot be said that those holding the depository receipts or the foreigners does not have a control or management, because it is stated in their depository receipt agreement that those foreign shareholders have a say in the management or the firm or the media cannot sell sell properties without the consent of those holding the depository receipts. Okay? So that's the issue nga gitanaw. So that's why it was decided that um, the foreigners who owns depository receipts, especially with this type of agreement, is unconstitutional because the foreigners cannot have a control and ownership in the media entity or in the media business. Impact of multinational operations on capital budgeting decisions. Okay, so the foreign operations are taxed locally. So if we are operating outside, then we can be double taxed because the operations or the profits outside is also taxed locally, and the funds that will be returned to the home country is also taxed, or the we call that the repatriated funds. And then the foreign projects are also subject to political risk in that particular foreign country. Repatriated funds must be converted to US dollars or to the home currency. So it is also subject to the exchange rate risk. So to what extent do average capital structures vary across different countries? So previous studies suggested that average capital structures vary among large industrial countries. So meaning that they have a different optimal capital structure or the mix of debt and equity financing. However, a recent study which controlled for differences in accounting practices suggests that capital structures are more similar across different countries than previously thought. So if they have the same accounting practices, same accounting standards, then probably they will have um, similar capital structure. That is based on a recent study. All right, to sum it up, so we have discussed the multinational corporation, reasons why firms expand their operations outside their home country. We also tackle the issues that would be faced by the businesses if they operate outside the home country. So we have to observe also the exchange rates because in the accounting standard, so particularly in the IFRS, we must translate or convert those currency to the home currency or to the country in which you are submitting your financial reports. So we have also discussed how to compute the cross rate, the how to direct quotation and indirect quotation. So using that um, to determine the price in other countries, computing for the profit. So so those operating outside their home country is experiencing what we call the exchange rate risk. So since this is a risk, so the management must do something how to hedge or mitigate this risk. And one way of doing that is to invest in the forward rates or to enter into forward contracts. So we have the international monetary system or the framework within which the exchange rates are determined. So we have the difference between the spot and the forward rate, the fixed and the floating. monetary arrangements. So in the floating monetary arrangement, we have freely floating, managed and managed floating, while in the fixed monetary agreements, so we have three. We have the no local currency, the currency board agreements or arrangement, and the fixed peg arrangement. Then difference between the spot and the forward rate. So when is the forward rate at a premium or at a discount? We also discussed about the interest rate parity. So the interest rate parities holds that the investors have the same return regardless of in which country they are um, in which country they are investing, as long as it is adjusted for the risk. So that risk is the interest rate risk. Then we have the purchasing power parity. So according to this parity, so the value of the goods in each country is identical as long as we adjust it for its um, spot rate. Then we have the effect of the inflation, international credit markets. So this is where the countries can borrow money. So we have the euro bonds, the foreign bonds. What are the American depository receipts? So as we know, there we in the Philippines we also have an equivalent of these receipts. So we call them the PDRs or the Philippine Depository Receipts. So these are usually invested by the foreign investors. So what would be the impact of those factors to in the our capital budgeting decisions? And then the difference of the capital structures across different countries. Okay, so that's all for today. So if you have some questions or clarifications, so uh, please feel free to message me in the Neo LMS or or in the messenger or in the in my personal email. Okay, so thank you for watching and listening to this lecture video.